and welcome to nabtrade's coverage of the federal budget for 2018. The federal government clearly flagged tax cuts would be the centrepiece of this year's budget, and they were indeed, although it's worth noting that these will be phased in over 7 years and will affect different people in different years. There'll be two groups who will benefit from the first wave of cuts as they come through, assuming they're legislated. A new low and middle income tax offset of up to $530 a year will be introduced from 1 July, which will be passed in full to those earning between $48,000 and $90,000 per annum. Those who earn below $37,000 will receive a maximum rebate of $200, and as with most rebates, it will offset tax, so you do need to be paying tax in order to receive it. If you're earning over $90,000 per annum, it'll phase out before cutting out entirely at $125,000. It's also worth noting that this isn't factored into your fortnightly salary. You'll get it back when you submit your tax return, which could be over a year away. From 1 July this year, there'll also be an increase in the threshold at which the 37-cent tax bracket kicks in, from $87,000 per annum to $90,000. That delivers a tax cut of $135 a year, so less than $3 a week, to those who are earning more than $87,000 a year. The next raft of changes doesn't come into effect until 1st of July 2022, so 4 years from now. At that time, the $37,000 threshold at which the 32.5-cent tax bracket kicks in will increase to $41,000, and the $90,000 threshold at which the 37-cent tax rate kicks in will increase to $120,000. So increasing quite significant tax breaks for those people. $540 a year for those earning between $41,000 and $90,000, and a little over $2,000 a year for those earning over $120,000 per annum. So that's where things become a bit interesting for that group. The new low and middle income tax offset will cease at that point, and the current low income tax offset will increase to replace it. So there's going to be quite a complex interplay between the new offsets and the ones that are currently in existence, particularly if you're also eligible for the Senior Australians Pensioner tax offset. From 1st of July 2024, so 6 or 7 years from now, the 37-cent tax rate will be abolished altogether, and everyone earning above $41,000 a year will pay 32.5 cents in the dollar up to $200,000, where the top marginal tax rate will kick in. That's an increase from $180,000 where the 45-cent tax rate kicks in currently. So that's very nice for those earning more than $120,000 per annum, and it equates to over $7,000 a year for those who are earning over $180,000 a year. As flagged, the planned increase in the Medicare levy to 2.5% has been abandoned, so the Medicare levy will remain at 2%. Small business owners and the self-employed will be pleased to see that the instant asset tax write-off has been extended until 30th of June 2019. This is an immediate tax deduction for expenses up to $20,000 per asset for businesses up to $10 million a year in turnover. It was originally introduced in 2015 as a short-term measure, but it's proven very popular and will be extended for another 12 months. For those retiring in the next few years, there is a budget announcement that super fund trustees will be required to offer members something like a lifetime income stream, which could include an annuity component and also some kind of market-linked component. There are also announcements about how these will be treated for Social Security purposes under the assets and income test, which is different to the current account-based arrangements. We don't think at this stage that these will apply to self-managed super funds, but should that be the intention, this could add quite a bit of complexity for trustees who are planning to start a pension in the next few years. Existing arrangements will be grandfathered, and this will only come into effect on the 1st of July 2019, so there's plenty of time for the government to consult on this particular one and for plenty of people to get clear and get a clear understanding of how it's going to work once it comes into effect. Under new measures, those who are over 65 but yet to turn 75, they'll be able to contribute to super if their total super balance across all accounts, accumulation and pension phase, are less than $300,000. This one doesn't come into effect until the 1st of July 2019 and only applies the year after they've last met the work test. The usual concessional and non-concessional caps will apply, and there's no bring forward arrangement available for this particular age group, so it's unlikely to apply to large numbers of people. For those young people who often have multiple superannuation accounts whose balances are eroded with perhaps insurance that they don't need and also with fees, there are going to be new caps on fees at 3% where balances are less than $6,000, and also an arrangement to make new insurance an opt-in for those under the age of 25 from 1 July 2019. For self-managed super funds from 1 July 2019, those funds with a good compliance record will be able to have their fund audited once every 3 years rather than every year. So that's rather an incentive to get your paperwork in order, and then you can save a few $100s each year in audit costs. Finally, two measures for older Australians. One is the pension work bonus, which currently allows those on the age pension to earn $250 a fortnight without affecting their pension payments. That's going to increase to $300 a fortnight from the 1st of July 2019, and it's also going to be extended to the self-employed for the first time. So an incentive for older people to transition to retirement or perhaps keep working for a little while longer. And finally, an expansion of the pension loan scheme, which currently allows eligible people to borrow against the value of their home or property. And at the moment, this is only available to those on a part pension or those who don't receive any pension entitlement because they're ruled out due to the income test or the asset test, but not both. This is similar to a reverse mortgage, but it's offered by the government, so the terms are quite fair. This measure will widen the eligibility of this particular scheme to all Australians over their age pension age. The total amount of the available loan will still be determined by things such as your age, whether or not you're single or in a couple, the equity that you have in your home, and the amount of age pension that you currently receive. However, the maximum loan payable per fortnight is going to increase, which is nice, and the total fortnight loan receipts plus age pension entitlement combined could be up to 150% of your current full pension amount. So this could become an attractive option for people who are asset rich but feeling rather cash poor in retirement. This one's going to come into effect from 1st of July 2019, so plenty of time for people to understand how it works and whether or not it's going to be beneficial for them. All in all, there were quite a wide range of measures in tonight's budget. Most of these won't take effect for quite some time, and they do all need to be legislated first, so plenty of time for you to understand how they might affect you. Thanks so much for watching. I'm Gemma Dale from nabtrade.